And it is Saturday, and we're going to be talking about money. One of the greatest investors of all time was a guy by the name of Peter Lynch. And a lot of people who have forgotten who he is. He was a money manager for Fidelity for the Magellan Fund through the 1980s and the 1990s. He delivered an average return of 29% per year during that period of time. And yes, it was a different time. And yes, there were not many downturns, although there was the downturn of 87, downturn of 91. But Lynch managed through those periods of time. Pardon me. There's a quote from Lynch, and I think it's really valid and something we're going to talk about today. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has ever been lost in corrections themselves. That was a quote from Peter Lynch. 29% for 13 years, and there were people who lost money, including one of my clients who actually invested in the Magellan Fund and lost money because he sold out during one of those corrections, during one of those downturns. What we call today drawdowns. It's when an account or a stock goes down. You measure from the peak to the valley, and that's the drawdown. We're going to be talking about that. And I'm going to be explaining today why I am so excited about 2022. And yes, we are in the midst of a drawdown at AFC. And I'm going to talk about that because it's so very important. If you look back, and I know you don't see the chart, I do. I'm looking at a chart of market declines in perspective. You see up markets and you see down markets from 1980 to 2021. And if you look in recent history, the market was up 18% in 2020, but the drawdown was 31%, which meant when the market from its peak to the bottom, when it peaked, it went from a peak to a bottom of 31% and then back up again to be 18 plus. The same thing in 2017, down 19% drawdown. If you look back at 2008, the drawdown was 48% from the peak to the valley. Looking back to 2020 to 2002, the drawdown was 33%. In 2001, it was 29%. That's 2000 was 29%, 2001 was 33, 2002 was down 14. Those drawdowns happen. 1987 was a drawdown of 30%. And sadly, that happened in one day, almost one day. Those are drawdowns. Those are times in which the market goes down and then begins to rally. I thought, if you look at where we were. Adams Financial Concepts clients reached a peak on November the 4th. And from November the 4th until March 14th, Pi Day, the Adams Financial Concepts clients' accounts are off just short of 40%, 39 and change. That's a huge drawdown. But think of what the possibilities are of that. $500,000 invested at the bottom, and nobody invests at the bottom. Very few people are lucky enough to invest at the bottom. But $500,000 invested at the bottom, if the market recovers and returns to break even, that break even point being November 4th, that $500,000 will be $1.25 million. I'm excited about this year because of the drawdowns and the potential, because I've seen very few times in my life, very few times in my investing life of 30 years, over 30 years, when I have seen such a great opportunity for our clients, for our new clients. I mean, things are so good. In 2020, companies had terrible profits. They'd hit the pandemic, places were closing down, people weren't going to work, people were losing their jobs. Even though the government was pumping money into the economy, still, company earnings were significantly down. So as we began to recover in 2021, earnings set records and the increases were record high. In 22, the earnings will probably once again be at records, but it will not be the gain percentage that we saw in 2021, simply because we're coming not from that mess of a pandemic. We're recovering from that. A lot of the recovery took place in 21. It will continue to take place in 22 and into 23, but the pace will be slower. The economy will be slower. And of course, we have a little war going on in the Ukraine as well. All of that is factoring in to a slower growth, but it's growth. We're not going backwards. We're not going into a hole. Things are moving along. The clients that we have, they've seen their accounts. If you started with us in 2018, you saw your account up 40% in 19 and 77% in 20. And even a drawdown of 40% means that you're still significantly ahead. You're ahead by more than 20% per year. So it depends in some cases where you start. There are clients that started with us. We have quite a few clients that started with us in 2021. They are down, but I think back on 2006, 7, and 8, clients that started with us in 2005 and 6 saw their accounts drop like the market. They weren't down 48%, but they were down 34%. It took a longer time for them to recover. I mean, we hit the bottom in March of 2009, but everybody was at a new high by 2010. And then they got the benefit of 11 and 12 and 13. And by 2020, every one of those accounts had surpassed the Standard & Poor's 500. Every single one. Not a one of those accounts was behind. The only account at the end of 2020 that was not above the Standard & Poor's 500 was an account of a client that dates back to 1986. And over half of her account was in bonds. And the bonds didn't recover, didn't have the recovery that stocks had. So that was the only account that was not producing returns that were superior to the S&P 500. Which brings me to another point. You know, there's a lot of gurus that say you cannot beat the 500, the Standard & Poor's 500. You should give up. You should lower your expectations. Charles Ellis wrote the book, Winning the Loser's Game, in which he talked about the people who were trying to beat the market were playing a loser's game. They weren't going to beat the market, so they should just lower expectations. You see a lot of gurus who say, keep your expectations lower. Don't expect to beat the market. We've had clients actually that have moved in whose financial advisor told them, be happy with a 5% return. We're not very happy with a long-term 5% return. We want to see at least 2 to 3 times that, depending upon the client reward risk. But that's where clients were and are. It seems to me that if I was underperforming the Standard & Poor's 500, I would be very likely to give that information to everyone else. There's a book called Thinking Fast and Slow by Daniel Kahneman. And he said, we want to think of ourselves, we want to feel the narrative of our life story as a positive one. And so when we're confronted with new information, that new information, if it contradicts our beliefs, we have 2 options. Either we can make a massive shift in our opinion, or we can ignore and discredit the new information. You know, the people who are underperforming the market, the gurus, they want to justify what they're doing. They don't want to admit that there are some, and yet they're forced to, in some cases, admit that there are some people who do outperform. And we actually publish our results of our client accounts. We put them up on the website. We report them out every quarter. We report how our clients are doing. And you'll see at the end of the fourth quarter last year, and probably the end of the first quarter this year, our clients are underperforming. We underperformed during the entire year last year. Doesn't mean we won't outperform coming up. We're coming to a commercial break, so don't go away. I want to continue on this idea because I am so excited about the prospects for 2022, even from the very beginning of the year, even from November 4th. I think the prospects are incredible. Incredible is probably not a good word to use with regulators, but I am very, very excited about where we're headed. Don't go away. I'll be right back. When we're confronted with new information, which might contradict our own beliefs, we have two choices. We have two options. We can either make a huge shift in our own opinion, or we ignore, discredit, or find fault with the new information. For me, I want to listen to new information, sift through it, and see how it straightens up. But Stanford Law professor and social psychologist Robert McCown did a study in which he found 75% of people who are involved in accidents, 75% blame someone else. And in multiple vehicle accidents, 91% blame someone else. And even in one-car accidents, 37% of the people involved in a one-car accident blame someone else. Think about this. These are some examples that he used. The pedestrian had no idea which direction to run, so I ran over him. Or the telephone pole was approaching. I was attempting to swerve out of its way when it struck my car. Think about that. I collided with a stationary truck coming the other way. A stationary truck coming the other way. A pedestrian hit me and went under my car. Think about the justifications of those. You know, instead of facing up to the fact of driving poorly, they blame someone else. And that's what happens with a lot of people in my industry. They blame something else. They say it wasn't my fault. It was somebody else. They'll say it was the mutual fund manager. They should have known that the market was going to go down, so we're going to sell their mutual fund and buy somebody else's. Or they're going to say the analyst was wrong on his assumption. They're going to blame someone else. I'm telling you, I don't blame anyone else that we have the drawdown we had. I think that the market is coming out of this whole time of the pandemic, and it doesn't know which way to go. It knows there's dislocation taking place. There's tremendous changes taking place in technology, demographics, and lifestyles. And I've talked about that before. Talked about it on this program. That is COVID, the Pearl Harbor moment of our lifetime. Pearl Harbor was an incredible time, a change of technology and demographics and lifestyles. Think of all the technology that came out of it. Think about the fact of the pandemic and companies determining and making a viral, vaccine. I mean, that's incredible. But you know what? In World War II, prior to World War II, Arthur Fleming, trying to find a cure for the Spanish flu, discovered penicillin. But and that was in the 20s. Throughout the 20s and the 30s, not until we got to World War II was anybody able to make it in quantity. It was a very tiny, tiny fraction of what people were doing. It was a very unstable molecule. But due to World War II and the need to take care of our soldiers, there was an emphasis and a whole lot of money poured into the into some companies to find a way to make penicillin en masse, to make it en masse. And that, it was, of course, Pfizer. We know about Pfizer because they made the vaccine. Pfizer figured out a way to make penicillin in production quantities. And that gave birth to the pharmaceutical industry. It was from that we got all the pharmaceutical companies, the Johnson & Johnson, the Bristol Myers, the AbbVie, the companies that grew out of that, out of World War II. That's just one example. We are living in one of those times. I believe we're living in one of those times when technology is coming on, and when you look at 65% of the trades that are done in the market are done by computers with computer algorithms, and they're looking at past data, and they're looking at where things came. They're not looking at the things like Pearl Harbor moment. They're looking at the technologies that have grown. And as we emerge from the pandemic and they look at the returns the companies are getting, there's a state of confusion by the algorithms. I'm sorry to say, the computers just don't understand. I understand that when I have a problem with my computer. I really get frustrated that the computer can't understand why I can't get done what I want it done. And I believe that same thing holds true with the stock market and computer trades. They're focused on looking at the past and extrapolating the past into the future. And that's not where we are. We're into a completely different time. We're into a different time with lifestyles and people working from home, working outside, working remotely, working some days in the office, some days out of the office. 5% of the population say if in the United States, say if they're ordered back to the office, they'll quit. They won't go back. 40% say if they're ordered back to the office, they will look for a different job. Think about those statistics. Think about the investment opportunities with that, but also think about trying to interpret that in lieu of where we were in the 1950s and 60s, 70s and 80s and 90s and the 2000s. That's what computer data is looking at. And so suddenly when you have a workforce that is working part-time remotely, the computers don't have data to support that because it hasn't happened before. And what hasn't happened before, the computers don't understand. And they lump a lot of things together. They lump a lot of things that were very good in the pandemic into once the pandemic's over, they think that's never going to happen again. But there's companies that were born, that grew in the pandemic, that are going to go on. Just as if the example I used with Pfizer, think about that. If you had computer algorithms going at that time and looking back at the 1920s and 1930s to project forward to the 1950s and 60s, they would look at a company like Pfizer and say, that's a one-off. And all these pharmaceutical companies that are coming up, the Johnson & Johnson's, Bristol Myers, they're not going to do so well. They did do well. That's the issue, and that's what's going on, and that's why some of these stocks are down. They are looking at past data and interpreting what's going on currently by looking at what happened in the 2020s, the 2010s, the 1990s, 1980s. They're looking at that data and interpreting it for today's data. And they're truly missing the changes that are happening. So what's the deal with a drawdown? Edward Renshaw, out of the University of New York in Albany, and it goes back some time ago when I read his studies. It goes back to the Great Depression, Great Recession, in fact. But he looked at all the downtimes from 1872 to 1990. He looked at that entire time. There were 42 times in which the market ended for the year, not just a drawdown. Every year has some drawdown, almost every year. But he looked at the 42 times when the year ended up minus 5% to minus 40%. And he looked at all the times since the Civil War. 29 times out of the 42, it happened because of recessions or depressions. But there were 13 times when it happened in good economic times. Think about the times it dropped in 1987. It was a negative year in 87. 1989 to 1990 was a negative year. And 2020. Think of all those times. Those are the times when it did happen with good economic times. And I say 2020. 2020 was not a good economic time. 2020 was somewhere between a recession and depression. But 87, 88, or 89, 90, those were good economic times. But the market still went down. In 87, it went down over 30%. 89, 90, it went down 20%. Both of those times. Tough times. So it can be either good times or recessionary depression time. But one thing that's common in all those times, about a third of the recovery from the bottom happens in the first 3 months. So if you find the bottom, you know you're about 3 months away from being a third recovered. Sadly, you don't know that you've reached the bottom until 90 days later. So afterwards, it takes up to 12 months to recover. In 87, it took only 9.5 months. And 12 months after the drop, it had gained 23%, 25% in the second year. And I think there's going to be something very similar for our account. I think that the recovery is going to be fairly rapid. And I wouldn't be surprised to see a 20 or 25% return for the year, even though we're down significantly right now. 1990, the market was down 13%. 12 months later, it was up 29%. And 24 months after, or the second year after, it was up 5.5%. So we're in one of those times. We're in one of those times. I believe that there's going to be recovery. And I believe that now is a wonderful time to get in and take advantage of that. Don't go away. I've really got a hoarse cough. Sorry about that. I believe that we're coming up to commercial break, so don't go away. I've got a lot more to talk about this, talk about what's going on. So stay with me. You can find our shows webcast on YouTube or also podcast on our website. Stay with me. We've got more to talk about. Warren Buffett once said, and talked about the difference between an investor and a speculator. And he said, and I quote, if you're an investor, you're looking on what the asset is going to do. If you're a speculator, you're commonly focused on what the price of the object is going to do. And that's not our game. That's not our game at Adams Financial Concepts either. But it brings me to a story that Ben Graham told about. Ben Graham goes back 100 years ago, 80 to 100 years ago. And he talked about how investment professionals do, and I believe it applies to algorithms as well. Not in the same exact pace, but Graham told a story. He talked about an oil prospector who was moving on to his heavenly reward. He had passed away, and he's met by St. Peter with bad news. And St. Peter tells him, you're qualified for residence, but as you can see, the compound reserve for oilmen is packed. There's just no way to squeeze you in. So the prospector, after thinking a moment, the prospector says, do you mind if I just say 4 words to the present occupants? So that seemed okay to St. Peter, seemed harmless. So he said, okay. So the prospector cups his hands and yells out, oil discovered in hell. And immediately, the gates to the compound opened and all the oilmen marched out and rushed into into the nether regions, into hell. And St. Peter, pretty impressed by that, he said to the prospector, you can move in now. There's no one here. And the prospector, he paused, and he said, I don't think so. I think I'll go along with the rest of the boys. There might be some truth to that rumor after all. Think about that. Who started the rumor? Anyway, it's a story, I believe, which illustrates what goes on in the market. I think it illustrates what Berard Baruch said, and Art Cashin paraphrased, and I've paraphrased. But the market is a perception market, and if it believes that 2 + 2 = 5, they'll pay 4 3/4 for it all day long. And the converse of that is if the market believes that 2 + 2 = 3, what they bought for 4 3/4, they'll sell for 3 1/4 all day long. It's a perception market. And it's why Buffett says, be fearful when others are greedy and greedy when others are fearful. It's easier said than done, but it is really the way. It is the way to do it. Be greedy when others are fearful and be fearful when others are greedy. Think about where we are today and think about the people that are talking about it. Think about this. If the stock market goes to zero, the whole country's in a much worse problem than the stock market going to zero. It's something where the market is down, but you know what? There are positives coming, and there's a recovery. And Renshaw said that the recovery happens in approximately 90 days after the bottom. And we're a couple weeks away from the bottom. I thought the bottom actually was in January. It turned out to be in March, or I hope it's in March. And we won't know for another 10 weeks. But what we do see is the market is down, and the opportunities when everyone else is fearful, it's a time to be greedy. Now is a time to do really well. And, people hate to think, as Coleman said in his book, Thinking Fast and Slow, people hate to change their opinion. They tend to stay with what they know. They tend to stay. And they do that. Instead of marching in and buying low and selling high, the majority of people buy high and sell low. Going back to Buffett, Buffett said if you're not willing to react with equanimity, if you're not willing to act to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get compared to the people who do have the temperament, who can be philosophical about the market fluctuations. And that wasn't Buffett. That's actually Charlie Munger that said that. There's going to be some times in which we're down 30 or 40 or 50%. Taking advantage of those times is really important. And we'll restructure client portfolios who bought at a higher time. We'll do some restructuring in those portfolios, and we'll take advantage of some of these down times. And you never know for sure what's happening. One of the great illustrations, I think, of understanding why history is different and why things change is the story of Listerine. Everybody knows Listerine, but it was actually invented in the 19th century as a powerful surgical antiseptic. It was later sold in distilled form as a floor cleaner and a cure for gonorrhea. But it wasn't a runaway success until the 1920s. Think about it. Listerine sold as a floor cleaner and a cure for gonorrhea, a surgical antiseptic. But it wasn't until the 1920s when somebody came up with an ad campaign as a solution for halitosis, chronic halitosis. Up until then, halitosis was not a well-known thing. It was an obscure medical term for bad breath. Listerine's new ads featured a young woman who was sad, a young man who was eager for marriage, but she was turned off by her fiance's rotten breath. And the ad said, "Can I be happy? Can I be happy with him in spite of that?" That's what the ad said. And you know what? Listerine, from very few sales, suddenly took off. And it became a very large product. Think about that. Originally a floor cleaner, a cure for gonorrhea, a surgical antiseptic, and somebody discovers by selling it as a cure for halitosis, the product takes off. Now, if you're a computer program looking at the history of Listerine and looking at the sales that were going on when it was a floor cleaner or a surgical antiseptic or a cure for gonorrhea, you're going to see very few sales going back that way. You're not going to be able to project forward the sales of a product that skyrocketed coming out of that. If you're a typical investor looking at Listerine back in the 1910s, before the 1920s, you're going to look at it as a floor cleaner, a cure for gonorrhea, and bad breath? You're going to make a real question. But those are the things that are happening. And I use Listerine because it's very familiar with what goes on. And the things we're going to see coming out of this time are going to be remarkable. And it is a time to understand. It's a time to understand what G.K. Chesterton said. And he made the comment, when there aren't enough hats to go around, the problem is not solved by lopping off some heads. Think about that. When there's not enough hats to go around, you don't solve the problem by lopping off heads. When there's not enough information, you don't go around by chopping off the sources of information. That's where we are. The investment strategy, if you're using an investment strategy, needs to be based on the evidence, on data, on logic, laying out the criteria completely. And don't be swayed or change the strategy unless you're convinced that the underlying assumptions and the underlying probabilities of the strategy have really changed. If they've changed, you need to change. But you have to look at the evidence. You have to look at the data. You have to look at the logic. You have to see where you are and why you are where you are. And that's why I am so excited about 2022 and about this opportune time right now to invest. We're looking at it in terms of the evidence. We're looking at it in terms of the data. We're looking at it in terms of the logic. Things have not changed from last year to this year, or from 2019 to 2020. Things have not changed dramatically. Yes, there are some changes happening, and yes, that's data and that's evidence which has to be considered. But the logic is there, and the reason is there, and the opportunity is there. You have to follow the evidence. You have to follow the data. You have to follow the logic, and you have to reason through it to see if there is a change. And if there's no change, you continue where you are. Coming to a commercial break, don't go away. I think there could be an application because of spring training opening. We'll talk about that once we come back. So if you've been listening to my program for a while, you know that I love baseball. You know that baseball, in my opinion, is a social sport. I had tickets to the Sonics. And if you said something to the person next to you, you miss 5 points. I share tickets with my son to the Seahawks, and it's so loud you can't carry on a conversation. But baseball, you can go an hour and a half before the game. You can talk about whatever. During the game, you can talk about the pitcher, the hitter, the teams, the pennant race if there is one, and maybe this year there will be one. But you can talk about all that. You can talk about family. You can talk about business, and you're not missing anything that goes on. I love baseball for that. It's a very social sport. But if you look at modern baseball, if you go back and look at prior to modern baseball, the period of time from 1903 to 1950, if you look at that period of time and compare it to the current day, in that pre-modern baseball period time, there were 7 players who hit over 400. Every 10 times they came to the plate, they got a hit 4 times. And those 7 players did it a total of 12 times. But since 1950, no one has hit over 400. No one. Since 1950, the average that the hitters have, if you look at the total average, combine all the players, it's held fairly steady since 1950 at between 250 and 260. You get some hitters. You get the Ichiros that hit 330, 350. You get that kind of player. You get some of the players like Zunino who hits 200. But you get an average of all the players between 250 and 260. But if you go back and look at pre-modern baseball, that period of time, 1903 to 2000 or to 1950, if you look at that, 1903 to 1950, the average player hit between 250 and 260. Same thing. So what happened? The standard deviation dropped from 40.6 in 1921 to 26.1 in 2003. Now, if you look at the standard deviation, what that means is a way to measure the disbursement. If you look at one standard deviation, 68% of the players will be within one standard deviation. 95% within 2 standard deviations, from the lowest hitter to the highest hitter. 3 standard deviations, 99% of the hitters will fall within 3 standard deviations. And 5 standard deviations, there's 1 chance in 3.5 million. So what happened? Why has no one hit 400? Because today's players are more skilled. I can remember Mike Moore was the #1 draft choice of the Mariners in 1982. And there was a full-page article in the Seattle Times talking about Mike Moore and his 95-mile-an-hour fastball. It was a rare thing. Very few players were hitting 95 miles an hour with their fastball. And today, there's multiple players who are throwing 100 miles an hour. I think the fastest pitch that I remember is 102 or 103 miles an hour. If you're throwing 95, you're not considered a real top-of-the-order thrower. You could use it. I mean, you look at Felix Hernandez, he was down in the low 90s, 92, 93, because he had a lot of movement on his ball, and he threw it where he wanted to place it. But in terms of velocity, there's a lot of pitchers who throw pretty well, and they throw 100 miles an hour. What's happened is the standard deviation has shrunk because the players have gotten better. And if you look at what's happened with money managers, I mentioned early in the program, I mentioned Warren Buffett. Warren Buffett in his early years was achieving 30% per year. Peter Lynch during the 80s and 90s achieved 29% per year. Today, the very best are achieving 20% or even less. You know, we've been at 20% from the bottom in 2009 to 2022. 2021. We haven't finished 2022. We're just at 20%. But very, very few people are achieving that. That's because the standard deviation has truly shrunk. The ability of people is becoming greater and greater. You know, Buffett was like Ted Williams. His 30% came early when people were really beginning to measure it. We don't see those kind of returns anymore. We don't see that happening anymore. Pastor Lubis, Robert Stambaugh, and Lucian Taylor looked at scale and skill and active management, a study done in 2013. And he said it wasn't rising skill due to an increase in the number of firms. It wasn't that new funds were more skilled than existing funds. It wasn't that younger managers were outperforming older managers. It was simply that the average skill across the board. It wasn't the average skill increasing across the board. It was because competition was increasing. And what we're seeing today is a shrinking standard deviation. You know, there was an article in Investment News not too long ago that said 4% was a good return. 4%. You know, when the standard deviation, or the Standard & Poor's is achieving a 17% return, there are people that believe a 4 or 5% return is a good return. I don't believe that. I believe that right now is a wonderful time to invest, but even if it's not until 2023 when the market is significantly higher, or I believe it will probably be significantly higher, you can never be sure, and past performance is no guarantee of future results, but even if it's 2023, even if it's 2024, I believe that the returns can be better than the Standard & Poor's 500. Not the significance of Buffett or Price or Templeton or some of those, but it can, in fact, work well. That's where we are. Just like in baseball, I do believe the skill's gotten better, and that's why we see a lower standard deviation. In the case of the markets, I believe that it's competition that's increasing, and computers are making 65% of the trades. You have very little data which is undiscovered. You have very few things which are underfollowed. And that's what we look for when we're looking for our portfolios. We prefer stocks which have 4 characteristics: that they have a squeaky clean balance sheet, which means that they have no debt. They have a franchise on the market, which means they have pricing power. That they have insider ownership, so that the founders of the companies and the owners of the companies have an incentive to see their stock price up. And 4, they're underfollowed by Wall Street, because Wall Street wants to follow all the big firms, not the emerging firms. And we believe that's a successful formula for finding stocks. And that's why we believe, and why I am so excited about what's going to happen for the rest of this year. And that wraps us up for today. I hope you have a very good rest of the weekend. Have a good week. And we'll miss April Fool's Day, which will be the Saturday. Anyway, have a very wonderful week, and I will be back next Saturday to talk about money. If you miss any of this program, you find it on our website. You can find it on YouTube. You can find past programs on YouTube about money. Log into About Money. You'll find them on YouTube. You can also find them on our website. Check us out. See who we are. Check out our performance. See what we've done for past clients.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590.